Best ways to own Canadian real estate investments. Hi, my name is Allan Madan from Madan Chartered Accountant. Today, I will discuss the best ways to own your Canadian real estate investments. The 4 different ways that you can structure your real estate investments are through A, sole proprietorship, general partnership, limited partnership, and corporation. Sole proprietorship. In Canada, a rental property can be acquired through a sole proprietorship. This means that you, the sole proprietor, will be listed as the sole owner of the property on the deed of purchase. You should consider becoming a sole proprietor when the value and risk of the property are low. This is because a sole proprietor does not have limited liability protection and could potentially lose all of their assets, such as their home, car, savings, and so on, if a tenant or third party were to sue them. A low value and low risk property has the following characteristics. It's located in a good neighborhood. The tenants are working professionals, have no criminal record, no prior evictions, and have a high credit score. The property price is not material relative to your entire investment portfolio. Essentially, buying and selling Canadian real estate for tax purposes through a sole proprietorship is simple. A sole proprietor will pay capital gains tax on real estate sales in Canada of a rental property. The capital gain on the sale is reported on Schedule 3 and line 127 of your tax return. In addition, you must complete Form T776, Statement of Real Estate Rentals, each year to report the profit earned from the property. Tip: having general liability insurance will protect you from lawsuits involving injuries or damages to customers, employees, vendors, or visitors that occur on the premises of your property. You should consider investing in this type of insurance, as tenant issues are fairly common. General partnership. A general partnership is a relationship between 2 or more persons with a common view to profit. Examples of a general partnership include joint venture agreements and situations where more than one person is listed as the registered owner of a property. General partnerships do not pay tax on profits earned. Instead, each partner is personally liable for taxes on his or her share of the partnership's income. How can a general partnership help me? A general partnership can help you save taxes by splitting income with family members or even unrelated persons. If you decide to make your spouse a partner in your real estate business, they can share the profit or loss similar to any other partnership. In order for your spouse to qualify as a partner, the CRA requires him or her to devote a reasonable amount of time to the business, contribute cash to purchase the business or real estate assets. Let's take the example of John and Jane, a married couple. John sells a rental property and as a result has a capital gain of $150,000. John's tax rate is 40% and Jane's tax rate is 30% without a partnership. Without a partnership, the gain of $150,000 will be attributed all to John. Remember, only half of the gain is taxable at John's marginal tax rate of 40%. This results in taxes owing for John of $30,000. With a partnership, if John makes Jane his real estate business partner, then he can transfer part of the capital gain to Jane. Instead of John claiming the $150,000 all to himself, the capital gain can now be split 50-50. By doing this, John will pay $15,000 of taxes on his share of the gain, and Jane will pay $11,250 on her share, for a total of $26,250. This results in a tax savings of $3,750. Limited partnership. A limited partnership is a separate legal entity where investors own units representing their ownership interest in the partnership. Money from investors is pooled together so that the partnership has funds to acquire a real estate investment. Usually, limited partners do not know each other or take part in the management of the real estate. The day-to-day activities of the properties is left up to a general partner. These activities include collecting rent, paying mortgages and taxes, maintenance, repairs, upgrades, and all tenant management. For individuals looking for a hassle-free real estate investment, a limited partnership is definitely a great choice. Taxation on real estate for a limited partnership in Canada. Partnerships relating to real estate sales do not pay tax in Canada. Instead, the income generated from the partnership is reported on the individual's tax return. For most limited partnerships, the CRA requires a T5013 partnership information return to be filed. The return contains important information about the partnership, including each partner's share of the partnership income for the year, including capital gains, each partner's ownership percentage in the partnership, and capital cost allowance, also known as tax depreciation, claimed. Partners are required to report their partnership income on line 122 of their personal tax return. If they have a partnership loss in the year, that loss can be deducted on line 251 of their personal tax return. Income from real estate sales is flowed through the partnership onto your personal tax return for tax purposes. General partnership versus limited partnership. Let's take a look at the example of John and Jane. Assume that John and Jane want to make their general partnership into a limited partnership in order to reduce personal liability. John faces the problem of deciding who to elect to the role of general partner. Remember, a limited partnership has to have at least one general partner, who is ultimately liable if things go sour. John doesn't want to be the general partner because he's afraid of the risk involved. In this case, John can set up a Canadian corporation to be the general partner. If John initially invests $100 of share capital into the corporation, this would be the corporation's only assets on its books. John can then make the corporation the general partner, owning 1% of the units of the limited partnership. Designating a corporation as the general partner will result in the corporation taking on all risk, but has limited liability protection and a nominal amount of assets. In this way, John has reduced his personal and his family's liability. This is a fairly common practice in Canadian real estate, as long as the management of the property is carried on through the general partnership, in this case a corporation. Corporation. The main advantage of buying real estate through a corporation is the liability protection that it provides. A corporation and shareholders are two separate persons in the eyes of the law. If your property suffers a loss or a potential loss that occurs, then your personal assets will remain unharmed. There are some negative tax implications when selling real estate through a corporation. In most cases, there will be double taxation. When the corporation sells a rental property for profit, it must pay capital gains tax. The other incidence of tax occurs when the after-tax profits of the corporation are distributed to shareholders in the form of dividends. When the shareholders receive dividends, they pay tax personally. There is some relief in the form of a dividend tax credit, which can help individuals reduce their personal taxes payable. Another major disadvantage of incorporating real estate in Canada is that the tax on passive investment income is very high. For example, in Ontario, a Canadian-controlled private corporation which earns investment income from rents, net of expenses, pays a tax of almost 50%. In conclusion, there are different ways to own your real estate investments: through a sole proprietorship, general partnership, limited partnership, or a corporation. The best structure depends on your personal circumstances. Consult with your accountant before buying real estate to make sure that you do it the right way. For more tax tips, please click on the subscribe button below and visit our website. Feel free to follow us on Twitter, Facebook, Instagram, and Google+. Don't forget to like, comment, and subscribe to our YouTube channel. See you soon, and thanks for watching.